Hello, everyone. Welcome to another month and episode of my live monthly market update. For those of you who are new to the show, my name is John Pasalis, and my team and I, at Realosophy Realty, of course, help buyers and sellers throughout the Toronto area. I like hosting these monthly market updates to kind of give everyone a look at what is happening on the ground, some of the trends I'm seeing a lot of times before they make the news, because we tend to see things on the ground before they're in the data, before they're in the statistics, and obviously a lot of times before the media picks them up. And of course, to ask your questions about the market, about your buying needs, selling needs, all of that. Urmi Desai from our editor at Move Smartly is available. She will be kind of keeping an eye on the chat. So please post your questions there. Going to go through some trends, going to go through the market statistics, going to talk about some on the ground anecdotes that we're seeing in our office. I mean, these are super important actually, because it's a lot of times the anecdotes that set the expectations of where things are going and the trends over the months ahead. And as always, we're going to have David Larock, mortgage broker, joining us to talk about some of the macro trends and things that he's seeing that might be impacting interest rates in the months ahead. And of course, as always, if you have any more specific questions, you can just shoot me an email at askjohn@movesmartly.com, and we can regroup on that offline in a little bit more detail. So moving forward, before we kind of dig into some of the latest trends, for those of you who are actively looking at moving, upsizing, downsizing, it is a very tricky time to be timing two transactions. So I have a 30-minute information session. You can click the link in the show notes below that unpacks how to do that, how to mitigate risk. Should you buy, sell first? Should you sell first? And what is the best strategy to kind of maximize your outcome? So you can click on that in the show notes below. So the past week was quite interesting. We had our Canada's Housing Minister, Gregor Robertson, make what I think was a pretty big comment in the Toronto Star when he effectively said that there's far too much condo product in both Toronto and Vancouver. That type of housing was overbuilt in recent years. So there's a market correction that many predicted years ago that we were in a housing bubble. This, of course, is a massive shift in tone from our government, who for years have been telling Canadians that home prices were surging 30% per year because of a lack of supply. All of a sudden, we have too much supply. I think I did a video this week that unpacks some of the challenges with his statement. It's not very nuanced. We don't have too many houses. We probably have too many small condos. We don't have too many family-sized condos. And, when we think about this risk, where we are today, one question, of course, was, could we have seen this coming? Or did this just happen out of the blue? Did we have no idea? And, one housing analyst, this one, yours truly, 4 years ago, had this to say about small units. And I said, when investors drive housing supply, it leads to the risk of overbuilding the type of property that investors are buying. Might we find ourselves with more 500 to 600 square foot condominium units than we need 5 years from now? And unfortunately, that's exactly where we are now. So, this idea that we couldn't have anticipated this. To be clear, I didn't call it a condo market a bubble, even though the pre-construction obviously was. And I didn't predict the oversupply. I just highlighted it as a very, very elevated risk. And it's not a risk that is specific to Toronto. It's a risk that is specific to all markets when investors drive new housing supply. So not surprising that we ended up here. And of course, how the market is going to adapt and pivot is anyone's guess. But of course, we still have a lot of pressure on smaller condominiums as a result of this sort of massive run up in prices, which kind of leads me to my next slide and kind of the other pieces I wrote about in my report this month. And that is what I'm calling sort of the hidden distress that is reshaping Toronto's condo market. I may have even touched on it in last month's monthly update. but I have a little bit more to say about it this month and a couple of examples. So one of the things that I've been noticing is a number of units selling for way below what they should be selling for. And when I say what they should be selling for, I'm saying relative to comparable sales over the past 3, 6, 9, 12 months, somewhat recent. Prices are down a little bit year over year. Condo prices in August, for example, are down 4% year over year. So I'm not talking about 4% year over year decline. I'm talking units that are selling for 20% less than what a similar unit sold for 6, 9 months ago. And there are quite a few of these. And again, these are the outliers, but we wanted to kind of go about to try to find these units and find these outliers. And this is a good example of where I think advances in technology like AI make this considerably easier than it would have been, in the past. In the past, of course, I mean, you got to write a lot of code. It's a lot of statistics because, again, we don't have perfect information. We don't have perfect data. We don't know exactly what units are worth at any given point in time, what their sizes are, those types of things. So you have to write code that kind of makes a lot of inferences and does statistical tests to figure out which ones are outliers and which ones are not. And again, AI tools that make this significantly more efficient. And again, the methodology we're working with, we're kind of testing and revising, but it helped kind of reveal a lot of these units. And again, I think on the topic of AI, I think it is a very interesting topic because if you look at what a lot of companies are doing, and I follow obviously what's going on in the real estate space, a lot of companies are using AI to kind of help agents become more efficient, automate their bookings and, automate their emails. I think the bigger, obviously, win is to help, analyze massive amounts of information to help people make more informed decisions, which is exactly what we're trying to do here, kind of mitigate the risk for our clients who are looking in particular buildings and units. So I'm just going to give a couple of examples of what I mean by outliers. I'm not going to kind of highlight the specific units or building. The point here is not to necessarily kind of flag one building or one buyer or anything like that. It's just to offer some examples. So as an example, in the fall in October 2024, a 2-bedroom condo, 850 square feet around Yonge and Bloor sold for $1 million, about $1,176 per square foot. Not a bad price. I think that one had parking as well. So, not a crazy price considering you're at Yonge and Bloor. Fast forwards to this year, same building, same layout, a unit, actually, I think it was 10 floors higher, ended up selling for $818, which is $962 a square foot, an 18% drop in, what is that, 7 months, 7.5 months, or whatever it was. So this is what I'm talking about, a significant decline in value over a short period of time. And another unit actually just sold more recently in July, I think for $770. It was a lower level unit. I think it was 11th floor, something like that. So I didn't focus on that one. I thought this would be more comparable because the one that sold for $818 for 18% less was actually, I think, 10 floors up. And, the higher you are in a building, usually there's a bit of a premium on the price. But of course, we've seen a big dramatic decline in the price in that specific building for those units. One other example I'll give, again, this is a 1+10 condo around 600 square feet around the Yonge and Eglinton area. Units in the fall in this particular building were selling for around $600,000. That's about $1,000 a square foot. Fast forward to last month, a similar unit to all these ones that were selling for $1,000 a square foot and $600,000, sold for $485, $789 a square foot, a 19% drop, in under a year. So these, I think, are units that we need to be worried about, that we need to be thinking about. Now, one question, of course, is why is this not driving down all condo prices, right? And there are a few reasons. I'm probably going to do a further vlog video to unpack this in a little bit more detail, but at a high level, for those who are watching today, there are a few reasons why this is not systemic, why it's not dragging all condo prices down, why average condo prices are still only down 4% year over year in August. Reason number one is these units are still the outlier. Okay, so they're not it's not the dominant trend. It is, I don't know how many hundreds of units we've seen in our analysis over the past 3 months. So I analyzed June, July, August sales specifically, or May, June, July, August sales against over the past year. So really, we're analyzing a handful of, I don't know, thousands of units against the past comparables. And we had maybe 200-300 outliers. That's number one. Number two has to do with the way agents look at and analyze comparable sales. So, the unit at Young and Bloor that I talked about that was down 20% or 18%, I can't remember, since the fall. A couple of things to keep in mind. If you're an agent or a buyer and you're looking at another building at your Young and Bloor, you're of course not going to notice that when you're looking at comparable sales, you're only looking at units in your building. So if there's no distressed sales in the building that you're looking at, you're of course not going to notice the distressed sale in the building across the street, is number one. Number two is, even if you're a buyer and an agent looking at a unit in that particular building, the comparable at Young and Bloor I talked was a 2-bedroom condo. Well, if you are looking at buying a 1-bedroom condo in that building, your agent probably isn't even going to be looking at 2-bedroom condos when they're pulling up comparables, because they're not comparable units. They usually sell for very different prices per square foot. So they're going to be looking at 1-bedroom condos as comparables. And this is, I think, the big risk that, as a buyer, as an agent, you're looking at 1-bedroom comparables in that one building at Young and Bloor, and you think $1,000 a square foot is reasonable, and you're not realizing that a 2-bedroom unit sold for significantly less just last month. So these are some of the reasons why we have not seen this flow through to the entire market. But I think it's an important trend that we're going to be looking at. We're going to be analyzing every month what buildings, what units are kind of the most risky ones, and have these signs of distress. And I think it's one of the things that we're going to be working on and looking at. So over the next little while, of course, as we refine our methodology and stats or whatever, I'll try to highlight more trends. Again, without talking about specific units and buildings, at least not publicly, because I don't really like kind of giving negative stigma to particular buildings. Obviously, this is informational. So we'll share it with our clients, but not, we can't advertise which buildings have distressed sellers or which seller was distressed. So going forward, I'll probably post more videos on this as we tweak our statistics and methodology. Before I go into the stats, I don't know if we have any questions. Actually, I'll go through the stats and then maybe take questions before Davin and Peter jump on. So a quick overview of the latest statistics kind of in the GTA. Detached home sales were up slightly, around 8% year over year in August. So it's the second month in a row where we're up a little bit. But keep in mind, it's not a bullish signal. We are still near 20-year low, 30-year lows almost in sales. So we are up over the past couple of years, but not significantly. So sales volumes are still soft. They're just a little bit better than last year. New listings are up around 15% for detached homes. Active listings are up around 18%. So again, inventory is growing faster than sales is growing, which is pushing the months of inventory up. And the months of inventory, as a reminder, is just looking at the number of units available for sale divided by the number of units that sold that month. And it is close to 5 months of inventory. And because inventory is outpacing, the growth in inventory is outpacing the growth in sales, we have downward pressure on prices, down around 7% year over year for low-rise homes. Again, I'm a little, I've kind of talked about this maybe on our show with Steve, I can't remember. I'm a little bit surprised by this. I think, especially when you think about the average decline in condo prices is lower, and I've mentioned it earlier, it's down 4% compared to 7% for houses. It is the opposite trend of what I would have expected. And again, this is why I don't like making predictions. I think it's, we don't know how the market's going to evolve, but it is important to look at the data. So yeah, to me, it's interesting that decline in prices is a little bit more aggressive, at least for the past month or so for houses than for condos. We'll see how that plays out over the next little while. Condo data, when we look at sales for condos, unlike houses, is actually down a little bit year over year, down around 2%. But new listings are also up 6%, and active listings are up 18%. And condo months of inventory is right around 7 months of inventory. Houses around 5, I think I mentioned. So again, there's a bit of a disconnect. But when we look at the downward pressure on prices, not as significant, as I said, down 4% year over year. And actually, the low-rise market has declined far more significantly from the peak than condos, partly because it also ran up a lot higher during COVID. So I think I mentioned in a recent video or post that low-rise home prices are actually down about 27% from the peak in February 2022. So on that, I don't know if we have any questions, Urmi, before we bring on Davin and Peter to chat a little bit about what we're seeing.
Hi, John. I actually think you anticipated Philip's question,
Okay.
which was around why detached home or low
Oh,
rises
so funny.
are performing relatively poorer than condos when it comes to price drops.
Yeah, so it's exactly what I said. When we think about the change in prices, I mean, it's like a lot of things. I mean, the higher and the faster you rise, the harder usually you're going to fall in the bust, right? And when we think about how prices changed during COVID, it was really, I mean, both, of course, low rise and condo took off, but low rise definitely, and in particular, detached homes in the distant suburbs, those skyrocketed during the COVID rush, right? So they had a far more rapid acceleration and are seeing bigger price declines from the peak. I think, what still surprised me is, yes, I'm not surprised that they saw a bigger price decline because prices largely dipped right after sort of the peak in 2022. Most of the declines happened between February in 2022 and the summer of 2022. And prices have largely, if you look at it, have largely been somewhat flat since then. We've had some peaks and valleys. I'm surprised, I think, at least from my perspective, in this period of, that we're in right now, that we're seeing a little bit more pressure on low rise recently. And again, I think I'm a little surprised because, again, it's the stock of homes we don't have as much of. I'm not surprised that it fell the most from the peak, but over this past little while, it's interesting to see some of these dynamics play out in the low rise market. And again, I think I mentioned in a BNN interview, again, one of the factors I think is that even with this decline, prices are still probably too expensive for a lot of people, given where rates are, in the low 4% range, right? So, in some ways, if you think about it that way, it's not surprising. But again, I think when we think about, and the narratives we hear about, low rise versus condo, yeah, it has been a little bit more interesting. I thought we'd see a little bit more pressure on condos. I think you're on mute.
There's actually an alarm in here. So thank you, Philip. Hope that helps.
All right. We will bring on Peter and Davin from our office to chat a little bit about some of the trends we're all seeing on the ground. We're both all obviously pretty active with clients, buying, selling. We hear a lot of stories. So, Davin, maybe we'll have you kick it off. What are some of the things you've kind of been hearing, I guess, from the clients you've been working with, the trends you've been seeing?
Yeah, I wanted to first answer a piece of Phil's question too, see if you agree with me.
Yeah.
Because we see the phenomenon of sellers being able to simply lease their units, I feel like you're probably have more success leasing out your condo, and I feel like maybe that will kind of take away some of those sales that might drag down the condo market itself. Because if you have the option to lease and you take it versus taking some crummy offer, I feel like that's something that can kind of prop up some numbers.
Yeah, that's actually a very good point. And I actually did some stats on this last month's live update in my report, where I showed that this year we're seeing a significant increase in the number of condo owners who tried to sell but didn't sell and then just leased their unit. And of course, as I mentioned last month, that's not a trend unique to now. Everyone's been doing that. A lot of people try to sell, they don't sell, they lease. But the trend is really that it was significantly higher. The number of people that abandoned selling and just ended up leasing, the proportion was much higher this year than last year. And to Davin's point, which I think is a very good one, that is a more realistic option for condo owners than for homeowners, even if it is an investment property. I agree with you. And I think, yes, that is probably one of the things that has supported the rental market or the condo market is that, when you're taking inventory off the market and just renting it, again, you're shrinking the supply effectively. Even though supply is still elevated, obviously it's taking away some of that downward pressure. Yeah. So that's a good point.
Because I've had clients in a similar situation where, they bought a home. They didn't need to sell the home, but their condo, but the preference was to do so. Mm-hmm. But if it came to pass, they'd be happy to rent it out. Although that was their second choice. We did end up getting an offer, and it was something that was in the lower value range, but still acceptable. And so just to facilitate the transaction of their buy and just sort of kind of put it behind them, like they're done versus leasing it out. Yeah, they took an offer that, I thought they could probably do a little better, but they said, you know what, we're happy to move on. We're okay with this. It's some loss, but it's manageable. And I think that's, how this kind of happens with, condo sellers taking less. They're strapped and they have to, or they're you know what, we're going to move on. We're okay. And they're not concerned about, the people who live above and below them who might see their values drop. I mean, that's the way the free market kind of works. And that's
and I think that's actually, I think, an important anecdote, because I think a lot of people think that everyone doing this is distressed. And in this case, a lot of these people who are doing it, they just want to move on. You know what I mean? Like, they're not the stubborn sellers like, I want to get X, and if I don't, I'm going to rent it. They have some number in mind, but if it's 30 grand less than what they were hoping for, you know what I mean? Like, they'll take a little bit less just to cut their ties, move on, and they're not as set on, maximizing their price. So yeah, and I agree with you. This can put a little bit of downward pressure on comparables in the same building if you have owners that are obviously accepting a little bit less than market value.
And it's like a domino thing, because the house that they bought is in a lovely area. But I do know that the sellers of that home were in the same situation. They had just tons of equity in it, and they were happy to let it go for, $50K more or $50K less than they probably would have got if they just like relisted the house at a higher price and waited. Same thing. So kind of just dominoes in the right way for people.
Yeah, and that's an important trend, because I think a lot of people think of condo investors as these distressed owners that are over leveraged. It's not the case. A lot of them just have had their units for years, have a ton of equity. And obviously, if you're in a position where you can buy your next home, move into it, and close while still owning your existing condo, you don't need to sell. No. Like, you're the type of buyer who has enough income and capital to float both, right? And in theory, rent it if you needs to, or if you can't get the price you want. But you're not a distressed seller. The distressed ones are the ones who have to sell to close on the home they bought. And to be clear, this is like a one of these situations where if you have to buy and sell, you never want to buy a house if you must sell your existing condo, because this is where you have no option but to accept potentially a lowball offer.
We were very clear on that conversation, saying like, it's not what price will you sell at, is will you sell at all? Yeah, that can be a concern. And so luckily we were very forthright. And so they ended up working out nicely. But I think that kind of speaks to, what you were talking about in the condo phenomenon of people taking less. I mean, not to the degree of like 20% that you showed, but still, that's how it happens, and it happens in many different ways.
Yeah, interesting. I had another interesting trend I've noticed. I've had a couple clients from living in Bloor West. They have a super nice house, detached home, very typical Bloor West home, and they're considering upsizing, right? And what they're looking at is, if you look at the market for dumpy homes, right, they're selling, as far as I'm concerned, like below market value, like below what I would think of as sort of decent market value. Whereas finished, really nice homes are still doing okay. Like if you are in a good area, you're renovated, you're in great condition. So they're thinking of kind of capitalizing on sort of this difference, getting a little bit of value, buying a fixer up or selling their current home and sort of renovating and upsizing. And the market there is kind of competitive for those types of homes. I mean, they were looking at a home yesterday or 2 days ago. They had 7 offers on it. You know, it was a dumpy fixer upper. And you know, when we looked at a bunch of the comparable fixer uppers on you know in the area, he was laughing because many of those were bought by people on his own street who are doing the exact same thing, basically buying dumpy fixer uppers, building them out, getting some value, and selling their current updated homes. So anyhow, interesting, some interesting dynamics.
Yeah.
Peter, I don't know if you've kind of been seeing anything on your end.
Yeah, actually, to add to what you're saying, I currently have a seller that's on the market. It's a condo townhouse, so it's a little bit different product, but yeah, but that's technically the conversation. Same with Davin. It's not so much are we going to sell it for a really great price? It's are we going to sell because they're in the situation where they want to sell to upsize. So
Mhm.
it's interesting to see that. It's great that you have sellers that are at least open to that type of conversation, and they understand what's going on in the market. Yeah, the numbers of the increase in inventory that we're noticing and the drop in price has definitely shaken that a bit.
Mhm.
But even with some other sellers that I've had conversations with, they're not so much looking to really bank on a huge profit. They breaking even is fine for some of them. That way they can at least they just want to move on. They don't want to have to
Yeah.
deal with it. They just want to sell and buy something to upsize.
Yeah, that's interesting. One other thing I think I've been noticing, and I talked about this last week when I was on BNN, and we were talking about the statistics, is you know we talked about how sales for low rise are up a little bit, and I think part of that is just people jumping in who see some value, who want to, you know, they're buying a home in an area they couldn't afford a year ago, and they want to jump in. But I think the more interesting story, and I don't know if you guys are seeing this, are I think there's still a lot of people who are just sitting on the sidelines who want to buy a home, who can buy a home, but are thinking, you know what? Maybe price will be a little bit lower in January. Maybe I should wait. I don't know if you guys are seeing that. I think I'm
Oh
kind of
yeah.
starting to see that a little bit still.
Yeah, I actually have a few buyers that exactly what you just said. They've been looking for about a year now, but because of the way prices have been going, and they're looking at condos too, because of the way prices have been going, they're now looking for, instead of a one bedroom at 650, they're looking for the 1+10s or the two bedrooms.
Mhm.
And they're hoping to time the market to find that distressed seller, or they're expecting prices to drop another 3% before they buy, in hopes of getting that deal, getting that bargain, and feeling really really great about it. But it's difficult. I mean, we don't have crystal balls. Mine's in the shop, but if I did have it, I'm sure it'd be very hard to try to predict when would be the best time to buy at any point in time in the market. But
Yeah,
yeah,
when all
a lot of that sentiment is out there for quite a few of my buyers.
Yeah.
yeah, when all the indicators of people, jumping in at the bottom, it's kind of once you see those, you're already behind the 8 ball. Um, Not to say that when that happens, there's gonna be a big run up, but you might be competing. You're probably not going to see those things drop in price. But I feel like the sentiment even is buyers are kind of baking those into offers, right?
Yeah.
I'm sure we've made or received lowball offers because the sentiment is prices are going down. You
Yeah.
can either take this now or you can take this in 3, 4, 5 months. Like, kind of take your pick, and then it's the seller's prerogative to do what they want to do. So I mean, it's not like it doesn't work. But yeah, there are people who are waiting, or they're just kind of jumping that sort of wait forward and just hoping that someone's going to take a lower offer than what would be considered right at value today. And sometimes it works,
Yeah.
and it doesn't.
I mean, 100%. I don't blame obviously buyers. I mean, if you're considering buying, you want to get the most value possible. I mean, I think to your point, if you want to try to go at the bottom, you have to eventually still buy when there's still uncertainty. You know what I mean? Like, and to your point is like once once all the green shoots are coming out and everyone's excited again and the market's rebounding, you're right. You're going to be in a potentially in a competitive market. But, even in the condo market, I think the examples I gave of these people who bought condos for 20% less than what comparable units sold for 6 or 9 months ago. My question is, are they, you'll hear two different arguments on the Twitter sphere and even in our comments. You're going to hear those people are stupid. I don't think they are. Like, they've already priced in a massive discount, right? Will prices dip a little bit more? I mean, who knows? But they've already gotten what I think is probably pretty decent value for units in the areas they're considering. So impossible to predict. Before we pull David on, Davin, you had an interesting story from our sales meeting about a funny, what I thought was pricing strategy and how it worked out on a house. Because I thought it was a kind of good example. So maybe unpack kind of what you saw, because I think there's like lessons for sellers and buyers.
Yeah. So yeah, I'll keep it as short as I can. So nice detached home for sale, East York, Leslieville kind of area. And this property was available for 1.3 million for the period of about 3 months. So they had it listed for 1.35. They dropped it to 1.3, and it sat there from mid-May until end of August. Right, that's a long time. And one would conceive that you could have bought that home for 1.25 in the latter part of that listing, term. Maybe less, maybe a touch more. I don't know. Nonetheless, they terminated that listing. They relisted it at 999, so 999,000 with an offer date. The marketing week passed. They had, I think it was 5 offers. So I just checked in on BrokerBay because I was curious how this house would do. Had 5 offers, and lo and behold, even though it was available for less for like the whole freaking summer, it sold for 1.305. And just kind of goes to show you, like, usually these 999, kind of Hail Mary things are just an attempt to, we just want to sell, get an offer, and move on, like we've been talking about. But yeah, somebody came in and gave them more than they could have reasonably got it for just 2 weeks prior. But that buyer who bought it may not have been around 2 weeks prior, or maybe they got some, some news inkling of the market, and they, kind of went for it. So it's kind of a funny strategy that usually looks like desperation.
Yeah.
And in this case, it probably was. Doesn't mean they have to take some crappy offer, but geez, it worked out. Sometimes they catch the Hail Marys, right? So that's how it went. So people look at that and just it makes me shake my head, because if that buyer was shopping 3 weeks earlier, you just paid extra for literally no reason. Maybe some FOMO, maybe who knows, but
yeah, it is interesting. I mean, and you're right. I mean, to me, the interesting takeaway, I mean, from the seller's perspective is that, you're on the market at 1.3 for 3 months. The idea of listing at 999 for the average seller seems crazy, seems desperate, seems whatever. But to your point, it can work. And I think especially when you're moving from the summer to the fall, when you don't know how busy the fall is going to be, because a lot of people hit pause in the summer, come back in September. And obviously that strategy work. I mean, obviously the follow-up is it doesn't always work. I mean, I see a lot of those. I see a lot of people do that sometimes. They're like, oops, that didn't work. Then they just end up relisting at like 1.25 or something like that. You know what I mean?
Well, let's be clear. They tried this strategy back in like April or March as well.
Oh, did they? Okay, the low ball price. Yeah.
Sale, list high, hot expectation, list expectation again, drop the price, run it out, and then do it again. Then it works. So I mean, they're probably very happy. And I assume the buyer's happy enough too. I mean, they paid the price for it. It's a nice house, but
yeah. Anyhow, but you're right. I mean, from a buyer's perspective, a lot of times you can just get more value if you're looking at the units that have been sitting there for 90 days. But
and to be clear again, they were never going to take 999K for that house.
Yeah, of course, 100%. Yes, exactly.
Might as well been listed for sale, $1. It's the same thing.
If they didn't get that, if they didn't get something reasonable, they probably just would have relisted at 1.25 or something like that, right? And dropped 50 grand. But anyhow, interesting story. Urmi, I don't know if you have any questions before we bring David on.
Brush off those crystal balls. Peter, get yours out of the shop, please. We have first a clarification question. I ask this a lot, John, of you as well. When you talk about condos or low rises, where do townhomes fit in? And I know I've always been interested in this topic. My understanding is, John, while in the condo sector, there are apartments and townhouses, the split is like 90% to 10%.
Yeah, so townhouses are a bit unique. So there's effectively two types of townhomes. There are what are called freehold townhomes. That is, you own the house, you just have a home attached to you on either side. Those exist in a lot of urban neighborhoods. They're usually 100-year-old homes. Those fall into the low-rise segment. So they're in the same categories, detached and semi-detached. Then there are condo townhomes. And condo townhomes, there's I'd say two different styles. There are styles that look like freehold townhomes. And by that, I mean you own the main floor, second floor, third floor, and the basement, and you have a home attached to you. But rather than it being freehold, it's a condominium, which means, some of the amenities are shared. And then there are what are called stacked condo townhomes that have like one unit on the second, third floor, another unit on the main, maybe another one in the basement. All of those types of condo townhomes are under the broader category of condominiums. And to your point, they're a much smaller share of the condo market. What we consider as condo apartments are the dominant. I mean, I don't know if it's 90-10, but it's highly skewed towards condo apartments, and condo towns are a much smaller share.
Yeah, you'd have to kind of like parse them out to get like real data on both.
Yeah.
Really.
All right, thank you. Staying on the subject, John, I think from your earlier numbers, when it comes to the condo so-called crash, Jet for Sale asks, are developers disproportionately focused on building luxury condos, neglecting the urgent need for affordable rental units and family-size homes? So I guess the question is, what is resulting in this mismatch of product? But my understanding is it's not necessarily luxury, it's the size of the condos that investors were after.
Yeah. Okay. So to answer the question, developers are not focused on building anything right now because they can't. No one's buying anything. But if we rewind the clock to why we built so many micro condos rather than family-sized units, to be honest with you, it's because prices are set by the marginal buyer, the buyer who's willing to pay the highest price, right? And the people willing to pay the highest price during the run-up were investors. They were paying 1,600 bucks a square foot for a condo when a similar unit across the street that just completed was selling for 1,100. Okay. What does that mean? If for a builder to build a family-sized 1,200 square foot unit, who's going to pay 1.7, 1.8 million dollars for that? Nobody. No, there's no family that's going to buy that. It's actually cheaper to buy a house close to the subway on the Danforth. They get one for 1.2. Why am I going to pay 1.7, right? So they weren't building those because investors were the dominant buyers. Investors wanted small units, and they kind of really determined what was built. And that's why I said at the start of my post, where when investors drive the market, it drives what builders build. It sets the prices, and that's potentially what leads to an oversupply, right? And they're very correlated. It's not that families didn't want to buy. It's, prices got to where they are because everyone thought buying condos was a get rich quick scheme, right? If end users were the dominant buyers of condos, they probably would never hit 18, 1900 bucks a square foot downtown because no one would have paid that 5 years ago, right? So it's not a single thing. I think they're very related. And we have a very good video on Move Smartly with a developer who talks about why the way Canada builds and finances condominiums is part of the problem. Like, we're one of the only countries that builders need to pre-sell 70% of units to investors to finance their construction. In a lot of other countries, they don't need to do that. They can sell 20%, say, and then the builder builds on spec based on what they believe the market needs. So they have more family-sized units. So again, it's not one thing. It's all like how we finance condos has a lot to do with it, who buys them. So there's a lot of factors behind it.
All right. And one more question about your earlier segment from Zen. How do you determine who qualifies as a distressed seller in your analysis?
So, I mean, there's not a specific, I think in my test, I put in any unit, and it's arbitrary for the record, but I think I put in anything that's sold for I think 15% less than comparable sales was my threshold. Obviously, that's arbitrary. I could have put 12%, I could have put 11, but I wanted something that was somewhat meaningful. And to me, 15% within a year is kind of well above what the average statistics are. So that's what I started as my metric, and some were 20% as we saw, right? So there's quite a few units that, and again, I'm calling these distressed sellers because I'm assuming only a distressed seller would sell 15% less than what a similar unit sold for within the past year, right? To Davin's point, yes, if they're not distressed, they're just gonna rent it.
Yeah. But what 3 scenarios make a distressed seller is a good answer as well.
What scenarios?
What 3 scenarios? Like, what's a handful of scenarios? So, like, the person who obviously bought a house needs to sell.
Yeah,
that's one. The other person is, maybe their condo went vacant, rents have gone down. I can't swallow, $300, $400 less a month in rent. And then another one might be just, renewing on the financing.
And they can't, or they're going to default. They can't afford it. Like, yeah. So there's a lot of scenarios for sure.
All right. And the crystal ball question, again, from Jet for Sale. Are we seeing a sustainable price correction, or is this just a temporary dip before prices begin to climb again? I think it's exacerbating the affordability issues. Yeah. We've seen this, John. We've seen this before, and maybe everyone can chime in. Sometimes Canadians get back into the market at surprising times.
Yeah, I don't know. It's hard to predict. Like, I think there's probably still pressure on the market this fall. Like, what the new year looks like is anyone's guess. Dave's going to jump on now, but now we're seeing people calling for the Bank of Canada to cut rates 3 times. 75 basis points is quite a bit. It's pushing rates closer to the lower 3s. Does that push more people in? Again, I don't know. You know what I mean? Like, I think it's easy to have a very bullish case. I don't think it's going to be to be clear, I don't think the market's going to be rising 10% per year anytime soon, right? To me, the bullish scenario for the spring is just a few more people start jumping in. We have flat prices rather than negative price, or something like that, right? So I don't think we're going to see, to that question, a rapid run up in prices, at least not in the next year or so.
All things aside, with an administration down south that is just so volatile, it's hard to have any confidence in Canada or, the economy or housing market on its own there. So, that's going to continue to play a part, I think, for the next, like 3.5 years.
Absolutely.
As I'm sure Dave's going to say, a very different scenario to the COVID dip and then rise in prices. Okay, right. I think that's it, unless there's anything more to add.
I think that's good. Thank you.
And also, Jet for Sale. Sorry, we'll put that video about the condo developer in our show notes.
Yeah, that's great. Awesome.
Good one,
guys. Right. Thank you so much.
Thanks, Davin. Thanks, guys. Peter. Sorry.
I'm gonna bring Mr. Larock. Hopefully, Dave has his crystal ball with him, because we're gonna ask some crystal ball type questions. Good day, sir. Pleasure. All right. David, thank you again for joining us. For those of you new to the show, David is a brilliant mortgage broker, writes a weekly column on Move Smartly, unpacking economic trends, macro trends. And that's really what I want to chat a little bit about today, is that a lot of questions, but we're seeing what I think, again, are mixed signals. And I think we had this story last month. And, of course, we're hearing about job losses, right? We're hearing about negative GDP print. But the one interesting thing is that thing that has kind of elevated or counteracted this decline in GDP is actually consumer spending, which is up roughly 4% year over year. And it was, like, again, an interest. I was out to dinner with a bunch of entrepreneurs a few weeks ago, and it was one of the things we were talking about. It's like, in everyone's business, are you seeing recession indicators? And everyone's answer was like, no, our business is doing great. Aside from real estate slower than normal, but like most people's businesses were not, we're not stressed. People were spending, people were buying, people were investing, people were renovating, or whatever their businesses were. And that, it was interesting conversation, because it's kind of consistent with the data that came out. So what do you think kind of are behind these signals? I think that are a little bit mixed when we think about where the economy is and where it's heading.
Sure. Well, the economy's in transition. And when the economy's in transition, not everything lines up at the exact time. It takes time for things to play out. And eventually, 6, 12 months down the road, things line up more closely and start to make more sense. So let's unpack the different numbers that we saw. The GDP data were negative, and that was largely because of trade. All the tariffs have caused trade to realign. There was a surge in trade in Q1 as people tried to front run the tariffs, and as businesses tried to front run the tariffs. And all of the inventories that they built up in Q1 meant that there was a lot less demand from those same businesses to buy in Q2. So the big change in GDP was a drop in trade. The surge in consumer spending is basically people saying, we know that prices are going to or we expect that prices will be higher because of tariffs. So we're going to buy whatever it was we were thinking about buying now because we think it's going to be more expensive in the future. Now, people say, well, why would we see that kind of, it takes confidence to spend. Why would we see that kind of confidence in spending when there's already job losses? And the surveys indicate that more and more people are worried about losing their jobs or about job stability. Well, the reality is the consumer spending is an aggregate number of all consumers. And there are consumers, the wealthier consumers, have discretionary income. They have savings. Canadians actually have elevated savings based on long-term averages right now. And if you're a wealthy Canadian and you think prices are going to rise, you're going to accelerate some purchases. What that surge in consumer spending hides, though, is that weaker, more vulnerable Canadians are already feeling the print. So if you read an article and you interview those people, they're going to tell you they're worried about job losses. They're going to say they're cutting back on spending, and it's all going to be very negative. But when that group is lumped in with other consumers who have discretionary income, who have money to spend in the event that they think prices are going to go higher and are looking at all of the talk about tariffs and saying, chances are this is going to cost me more in 6 months if tariffs raise prices. So they're accelerating their buying. So some of that mixed signal effect is a cause of two things. The cycle is turning, and right now it's affecting trade, but the pileup, also the increase in inventories that we saw. Businesses can sell their existing inventories that they stocked up pre-tariff without having to raise prices, and it takes time for that to happen. So there will be a lag before the impact of tariffs is reflected. Let me fast forward though a few months here, John. Interestingly, the U.S. is only the added tariffs since Trump's announced all these tariffs on Canadian imports is only 2.5%. The U.S. is actually charging more to Mexico. Mexico's at 4%. Canada, because of the USMCA agreement, Canada is the least impacted of all the countries. And right now, the U.S. is actually not being too hard on us. So when you look at the impact that actual tariffs have had, they aren't that significant as yet. And also, Prime Minister Carney has canceled a bunch of the counter tariffs, again, because of the USMCA and trying to keep the negotiations on track. Interestingly, most of the negative impact from the whole tariff war has been Canadians changing what they buy, and the U.S. economy has been hit harder. It's bigger and it can absorb more impact. But Canadian consumers have done a lot of the heavy lifting, where we don't necessarily need counter tariffs to retaliate, because we've significantly cut back on buying U.S. products. And that's really the only negative impact, the most significant one anyway, that has been seen thus far. The challenge we've got is that even though the actual impact of tariffs right now is still pretty minimal, it's affected psychology. It has affected the plans of some businesses in terms of investment and planning for the future. I'd say it's certainly tied to some of the job losses that we've seen in the sectors where we're seeing them. So it is having an impact, but the impact right now is on planning, on jobs. It's not actually affecting prices yet. Interestingly, if it does slow the economy, and if we don't see much increase in prices, the net impact of the tariffs could be deflationary. Now, that might mean that the Bank of Canada has room to cut, because when we have a recession, rates typically fall during a recession. The Bank of Canada would be expected to cut during a recession. And if we have job losses, we're not going to have wage growth continue to be above the rate of inflation, which it has for the last 2 years. So all of that could end up being a bit deflationary. But if you're
Sorry,
looking for a fixed rate,
unpack that one more time. Why do you think it could be deflationary? Because I kind of
well, the actual impact of tariffs on prices is effectively a wash. The cost of the average increase in the price of a Canadian export to the US is 2.5% right now. The average increase in terms of what we are importing from the US, the price increase because of counter tariffs, after Prime Minister Carney clawed back most of them, it's less than 2.5%. So the impact on prices isn't really there. It's mostly psychological, and it's affecting businesses, and it's certainly curtailing investment plans, and it's leading to layoffs and affecting our employment market. But it's not. So if we have layoffs, then that means we have less demand for labor, which means that there's more supply of labor, less demand. That should put downward pressure on wages. The actual impact of tariffs on prices is minimal. So let's say those two cancel out, but that overall we get a slowing in economic growth because businesses and consumers become more cautious in the quarters ahead. If we get a slowing in our economy, that typically would relieve some pressure on inflation. And if inflation pressures are relieved, that is deflationary. So ultimately, now, that might mean the Bank of Canada cuts rates more than expected. Remember, the Bank of Canada wasn't planning. The market didn't think the BOC was cutting at the next meeting. I've been pretty consistent, and I haven't been right. I've said I thought the bank was going to keep cutting, and they haven't done it. But the reasons why I said I thought the bank would keep cutting are now coming to fruition. The timing of when this stuff happens is difficult to predict. Anybody can look like a fool when they try to put a timeline on it, but the trend has ended up manifesting as I expected it would. We're getting a slowing in the economy. The inflation pressure has eased to a point where now there's not a red light flashing over our inflation data anymore. So the BOC now has more flexibility to react to the slowing economic momentum and to give the economy some stimulus. As a reminder, the BOC's policy rate right now is at 2.75. That is the dead middle of what's called its neutral rate range. That means the monetary policy the policy rate at 2.75 isn't stimulating growth in our economy, but it isn't restricting growth in our economy. If the BOC wants to stimulate growth in the economy, by its own estimates, its policy rate has to go from 2.75 down to 2. And by the way, in its last 5 rate cut cycles, we're still in the midst of a rate cut cycle, going back 25 years, it's always cut its policy rate to at least 2%. So if you don't think the BOC is going to 2, then you're betting against 25 years of precedent, and you're also betting that the economy won't ultimately need stimulus. Now, that was a contrarian call up to a month ago. The latest employment report now has the market pricing in a 90% chance of a BOC rate cut at its next meeting on September 17th. We'll get the inflation data next week right before the BOC's meeting, and that will certainly be a factor. And the bank probably has that data ahead of the market. I would almost assuredly think that would be true. So we'll see. I think we probably get a cut. I think we're going to 2. And like I said, that was a contrarian call up to not long ago. But the factors, again, I didn't get the timing right.
For sure.
I didn't have a strong opinion on what the timing would be. It was really the trend that I tried to identify, which was weakening growth and inflation allowing enough room for the BOC to cut, and the BOC ultimately landing on 2. And I think those things are playing out.
Your crystal ball is not good at timing, but it's good on the future prediction. There you go. So on that note, I mean, kind of going back to the question we had earlier, if we see the BOC cut to 2, I mean, probably by the spring sometime, obviously probably not this year. Do you see that stimulating housing? I mean, I think it does a little bit to some extent. I don't think we're going to rally, but I'd be surprised. Like at that point, we're gonna have what, variables in the lower threes or mid threes, something like that.
Yeah.
So, I mean, and I'll follow that up. I mean, does that impact housing? But also, actually, no. Before I ask my follow-up question, what do we think is going to happen to housing?
I don't think it's going to be the kind of stimulus for housing that we saw during COVID for a couple of
100% no. I agree with you. Yes.
for a couple of reasons.
Yeah.
Prices are still much higher now than they were then. So, affordability is strained to such an extent that it will help a little. It will help to some extent, but not enough to turn a balanced market into a bullish market again. Also, I think we're going to see job losses. I think we're going to see slowness. And as I said in a previous call you and I did, the last couple of times rates have dropped. We've had lower rates, but the economy's remained strong. In 2008, our rates dropped. They followed U.S. rates lower. The U.S. had a housing crisis and an severe economic recession. Canada didn't have a recession in 2008. So rates dropped. We didn't get the economic headwinds that came with it in the U.S. House prices went up. During COVID, rates were slashed. Our policymakers thought we'd get a sharp economic slowdown, didn't arrive. So rates were slashed, rates went lower, house prices went up. People not paying close attention to the detail would say, well, that means every time rates go down, house prices go up. Well, this time rates are going down because the economy is really slowing. So this is an apple. Those were oranges. To me, I don't see the same economic conditions if rates drop. This time it'll be because unlike the boy who cried wolf, this time the wolf is actually showing up. And ultimately, if we have job losses and we have slowing economic growth, that'll affect buyer confidence. Affordability needs relief. I think it'll make things, it'll help, but it won't solve the problem. House prices need to come down in addition to rates falling. And to me, both of those things have to happen probably for a period of time before I think we'll see the start of the next positive cycle in real estate. Right now I don't know. I mean, we're dropping a little, John, but it doesn't seem like we're certainly not in the crash. The Pollyannas who've been calling for the sky to fall. I don't know. Are they doing their touchdown dance now? I mean, we've seen prices drop 5-10%, but is this what they were warning about for all those years? Because if so, I mean, this still feels like mostly a balanced market.
Well, I mean, it does now, but we are still down 27% low-rise homes from the peak, which is quite significant, right? So, and again, I think most of that, I'd say the 20% happened 3 years ago. We've been pretty much flat since then. But again, I don't know. We'll see how the market plays out. The other question I wanted to ask you was about fixed rates, which, to unpack for viewers are, of course, driven not by what the Bank of Canada does, but are driven by what's going on in yields for 5-year Canada bonds. And those yields, if I'm not mistaken, have been trending down recently. So what do you see? And you had a great quote in your article from Buffett about bond yields and how the bond market reacts to news. So what do you see happening with kind of bond yields and fixed rates in the months ahead?
Well, that's a U.S. story where variable rates are directly responding to Bank of Canada rate cuts, and the BOC is going to put almost all of its attention on what's happening here at home. Government of Canada bond yields follow U.S. Treasuries, and U.S. Treasuries had been trending higher because there was a lot of concern about spending, the big beautiful budget, the record levels of U.S. deficit spending, and that has had investors quite concerned for some time about whether or not inflation in the U.S. is going to get under control. They never got to 2%. And we just got the latest U.S. inflation data this morning, and U.S. inflation is higher. But in the short term, the Fed is expected to cut because the jobs report was weak. And the Fed's in a real bind because they have a dual mandate. Unlike in Canada, where the Bank of Canada is just supposed to maintain price stability and keep its eye on inflation, the Fed has to maintain price stability and maintain and support full employment in the U.S. economy. So they have a dual mandate. They have to promote healthy employment, and they have to keep inflation under control. Right now, they're getting a D grade on inflation, but they're in danger of getting just as bad a grade on employment. So they may cut. The market thinks there's a 100% chance they'll cut. That's certainly expected. But when they do, they're going to have to explain to the bond market why cutting now to help weakness in inflation is okay in light of the fact that inflation is moving higher and fiscal spending is at the highest level it's been since World War II, when the U.S. had soldiers coming home from the war and needed to retool its entire economy from being a wartime economy to a thriving balanced economy. So it is a very tough tightrope that Powell has to walk right now, justifying those two things. And if the bond market doesn't think that the U.S. is going to get inflation under control, U.S. Treasury yields are going to resume their upswing. They've fallen a little bit lately because of the weak employment stuff and the expectation of the Fed rate cut. But as I borrowed that quote from Buffett, they vote in the short term, but they weigh in the long term. And when they weigh, looking forward, if they think the Fed shouldn't be cutting now because inflation is already too high and set to move higher, and I think it's reasonable to think that for as long as Trump is president, he's not going to have a lot of concern about inflation. As you know, there's only three ways the U.S. pays back its massive debt. It defaults, that'll be chaos. It actually pays it back. I don't think that's going to happen, especially not when Trump is president. And the third way is to inflate it away. And when you look back over history, that's typically how countries deal with too much debt. So if you're a bond market investor and you're looking at the U.S. Treasury yield right now, if you want to buy a 10-year yield and you think that there's more inflation coming, you're not going to buy until the yield's higher. And yes, over the short term, the fact the Fed's going to cut has the market thinking that there will be a bit of a reprieve in short-term rates. But Canadian fixed mortgage rates are priced off of Government of Canada bond yields. If you want a 5-year fixed mortgage rate, you're going to, our Government of Canada bond yields are piggybacking on U.S. Treasuries, and that's a longer-term loan. And those investors, when they see that higher inflation lasting, are going to want more. They're going to weigh that. And I think ultimately yields will resume their upswing. I think this is a temporary dip, and I think they're headed higher again for all the reasons they were headed higher before the last U.S. jobs report.
That's interesting. I mean, the one interesting thing about the U.S. dynamic is I always thought that the conservative and Republican parties were the parties of balanced budgets and low deficits, but clearly not is what we're seeing. Urmi,
the last 3 times the U.S. budget was balanced, there was a Democratic president, by the way.
Fascinating. Fact versus fiction. Anyhow, we're gonna get some angry commenters about that who don't like the facts. Clearly. Anyhow, Urmi Desai. I don't know if we have any questions.
No, a very lively chat. I think your comments are stimulating some good chat. Carl, I apologize. I accidentally deleted all your comments. That was just a technical error. But thanks for participating in the chat. Just a lot of lively back and forth between our viewers.
All right. Any no specific questions for Dave or myself before we wrap up?
I don't think so. I think a lot of reactions to where we might land on all the topics you've mentioned: Trump, tariffs, Canadian resilience, and so forth.
All right. Beautiful. Everyone, David, thank you again for joining us. Urmi, thank you for moderating. All of you, thank you for your joining, for your lively questions. And as always, we will see you here again next month.